The key to a soft landing is a Fed getting off data dependence. Okay. By the way, and that's a way Wall Street can help kind of, or big money in general can help kind of fix things the way they want it to be fixed. So let's say you feel like a certain president's going to get in office, right? And you don't like that person's policies, and so you want to kind of block them from getting things done. You can donate massive amounts of money to help another candidate, get elected and run ridiculous amounts of ads for them, put together the best anti-ads for their opponent and things like that, and try to help win them the election the best way possible. So then that person can help kind of block. There's a lot of games that are played in politics that I don't think a lot of people quite realize, but there's a lot. The key to a soft landing is a Fed getting off data dependence, Tom Lee.
Managing partner of head of research at Fundstrat Global Advisors, as well as a CNBC contributor. A month ago when the VIX hit 50 and there were growth fears about the economy, did you ever waver? Did you have any nights where you didn't sleep as well?
There were 3 days of horror, as the market post FOMC all the way to that Tokyo Black Monday. It was gut-wrenching.
Was it? For you?
Yeah, yes. But we viewed this ultimately as being a growth scare, because we didn't think the U.S. was entering recession, which a lot of people thought after that jobs report. And I think people thought there was systematic risk because of what's going on with the yen. But markets showed a lot of resilience since then. I mean, the fact that we snapped back so sharply is showing you how strong this market is.
Still.
Yes.
The revisions yesterday, not on your radar. Should they be on investors' radar screen? I thought it might be a good thing if the job market was not as hot as people thought.
Yes, I think it is incrementally important because the FOMC minutes that came out yesterday as well showed the Fed staff saying this is a strong labor market. Well, that jobs report that came out Friday and the revisions that just came out show a lot of jobs disappeared. It's not as strong a market. And I think it gives more ammunition for the Fed to start a cutting cycle. Mm-hmm. And that's going to give a lot of life to the economy.
And to the markets.
And to the markets, especially cyclical stocks and small cap stocks.
I mean, it depends here, right? It depends on how much the Fed cuts, how fast they cut. In terms of giving life to the economy, let's be really crystal clear. If the Fed cuts 25 basis points, does that make any substantial difference in the economy? No. Does it make any substantial difference in corporate earnings? No. It does nothing. Do a 50-50, you do 100 basis points in a year end. Okay, now we're at least starting, right? Now still not, even 100 basis points still doesn't change the game. That's just like, okay, we're moving in the right direction. Now you drop 200 basis points, 300 basis points, then you could talk about really starting to positively affect the economy. And rather than putting the brakes on, you're putting the gas on a little bit. You cut down to zero, then you're full on gas at that point in time, right? But 25 basis points, they cut that. Or even if they cut 25 in the year end, like that's like nothing, man. That's nothing.
Tech's already done well. So normally you'd think lower multiples could expect, or at least multiples don't need to stay where they are or contract with a high multiple tech stock. So
and Jerome Powell has the perfect excuse to cut 50. With the recent jobs data, with a massive revision of over 800,000, right? And he has a perfect excuse. Obviously going into this, going into the rate hike cycle, we went way too slow. We started out with 25. We made a big mistake, right? We want to make sure we don't make that big mistake again when we're going to cut, which is why we're going to start out with 50 basis point cuts here. So as we begin this cut cycle, we're doing it a little more aggressively because we don't want to make the same mistake we already made on the other side. We didn't go up nearly as fast as we should have, right? Or as early as we should have. He's got multiple angles of a perfect excuse here to go 50 right off the bat.
But at least feel better about the valuations if rates came down.
Yes, that's right. I think tech is still in a good place because of AI, and NVIDIA should reinforce that. And it's not a demanding multiple. NVIDIA is maybe 28 times forward earnings, which is for one of the most important companies in the world. It's not a high multiple. So
28, sometimes these Tom Lee numbers, I don't know where he gets some of his data. I'm going to be honest with you guys. I don't know where Tom Lee gets some of his data. Because I listen to him say some of these things sometimes, and I look out there, and I'm like, that's not accurate. Where's he judging his numbers off of? Sometimes he'll talk about, small cap stocks had 10 PE, 10 forward P or something like that. And I'm like, what's he talking about? Like, that's not accurate. So I like sometimes he says some of these things and I'm like, it's just not accurate even remotely. And say Nvidia's at a 28, it doesn't look like that, right? And keep in mind on 1000X, we're taking into account analysts' expectations on average. So if they were to hit a 28 here soon, they're going to need to be a mile ahead of where analysts are at. And keep in mind, analysts have gotten more and more bullish on NVIDIA over the past year. So to try to beat these numbers is going to get tougher and tougher. So, man, sometimes his numbers, I'm just like, where are you getting those, Tom Lee? Where are you getting them, man?
If tech is in a good place and then we get Fed cuts, I think it allows the overall market to expand.
Do we see an orderly easing cycle because the Fed doesn't feel like it needs to act intra? They have a meeting where they go 50 or whatever. You think they just 25 and then the next meeting 25, so only do 50 this year and then maybe continue next year? You think it'll be like that?
I think that a soft landing is, the probabilities are going up, and that's why this should be a benign cutting cycle, like good for markets. But I think the key is the Fed getting off data dependence, because data dependence is the reason they missed the inflation turn, and I think now they're missing the soft landing.
Rear view mirror. But is it possible that they're too restrictive right now, and that the lag isn't? We don't know how powerful the lag effect of the higher.
Joe just totally missed an opportunity there. Did you hear what Tom Lee just said? Like, how did Joe miss this opportunity? Did you hear what Tom Lee just said?
I think now they're missing the soft landing.
Rear view mirror. But
now they're missing the soft landing. Tom Lee just said, quote, now they're missing the soft landing. You got to go back in and attack that right now if you're Joe. What do you mean they're missing the soft landing? So you think they're going to lower too slow here? You think they need to go 50, 75? You think you're not lowering fast enough? They should already been lowering? What do you mean by that? Like you can't just let, Joe, focus a little more on listening and not talking, dude.
They missed the inflation turn, and I think now they're missing the soft landing.
Rear view mirror. But is it possible that they're too restrictive right now, and that the lag isn't? We don't know how powerful the lag effect of the higher rates could be, and they end up doing 50 or doing a couple of 50s. Is that possible?
I think futures markets are showing more than 2 cuts, so I think the Fed probably is a little behind the curve, and we know there is a recession in housing and durables and auto sales, so there was a lot of pain out there. So cutting more aggressively would actually make sense, at least from the market's perspective.
Where do you think, well, you're a market cap, but where do you think unemployment tops out? Do we get to 5? Do we go over 5% unemployment?
You know, a lot of it has to do with how the Fed communicates to CEOs, because a lot of companies are cautious, right? With monetary policy this tight and real rates this tight, it makes them reluctant to expand. And so the job market itself kind of hinges on what the Fed's doing. And yeah, it could, once the job market starts seeing unemployment rise, it could get bad.
I think Bitcoin's 60,000, give or take. Gold has been hitting new highs, obviously. I think we showed a chart the other day. Kelly was trying to tell me she had been right about
the disconnect.
No, about gold being a bet. So we looked at it over the last 5 years, or I don't know how many years, but gold was up 90% and Bitcoin was up 13,000%.
Okay.
That was that we looked at. So I mean, gold is moving, and it's moving not in a correlated fashion with risk on, whereas Bitcoin definitely looks like it's just a
Does that ever switch?
I think it can. I mean, Bitcoin is just sort of got 2 functions, right? Because it is a risk-on asset, but I think it's an important protection against systematic risk.
Do you ever want it to be correlated to gold?
I think Bitcoin is digital gold, so I think it's replacing gold over time.
So eventually it should act like gold, which means that it shouldn't have the kind of meteoric rise that we're talking about here.
Well, it depends on what the dollar does, because there could be a day that dollar could debase, and then you'd want to own a lot of Bitcoin or gold. But, I mean, to me, the fact that gold's rising is showing you there's still a lot of fear out there. I mean, I think gold is almost a measure of the bearish sentiment, and that's why I think stocks still
Do
have
you
upside.
have,
That's
can
fair.
we talk politics for just 1 second? Do you have an election prediction as it relates to the market? Do you think the market do you think anything we're seeing in the markets has anything to do with what's going to happen in November?
Yes, to an extent. I think that the markets are believing Trump's probabilities of winning are stronger than the polls are showing. But I think when the market sort of becomes more convinced of that, I think you'll see cyclical stocks do better, small caps, Bitcoin do better.
I don't think so. I think, everybody always looks at the presidential elections. That's the big one, right? And that's always the focus. But the market could also be looking at it, and they could be saying, we're going to have a split House Senate situation. Whoever's in office isn't really going to be able to get anything done. And so whatever's been going on is going to keep going on. There's going to be no major tax change and those sorts of things. That's another way the market could be looking at it. So I know everybody just focused on the presidential election, but there are elections outside of the presidential election that matter significantly to, if you're actually going to get anything done or not.
Because these are really clear policy differences. But yes, to me, I think over the last couple of days, to me, the market seems like it's betting on Trump's odds being better than the polls.
Okay. All right, Tom, thank you.
Thank you.
Yeah, worst case scenario for the market would be Dems take everything. Harris wins and Dems just take it across the board and then the market have a full meltdown at that point in time, because then we'd be talking about, oh my gosh, like they might actually do the 28% corporate tax rate 7 percentage points away. Then you need to lower the stock market by a minimum of 7 percentage points, like overnight essentially, right? And then if we talk about some of those other tax changes being more of a concern, which some of them, even if they took everything, they wouldn't get them through, like capital gains, like some of those, no. But in terms of corporate tax rate going to 28, if Dems took everything across the board, yeah, that's a real possibility, and the market would flip over that.
And Chief Investment Officer of T. Rowe Price, where he oversees nearly $500 billion in assets for the firm. How has your view, Sebastian, and thanks.
I doubt the powers to be will let that happen. I doubt they'll let that happen. Hey, I want to thank you so much for watching that clip here today. I hope you really enjoyed that one. What you're looking at right now is 1000xstocks.com. 1000x does not just show you a billion different metrics that are completely irrelevant. It's curated, mandatory metrics, advanced metrics, curated for long-term investors, not for traders, so you can understand a company on the highest level possible, how it operates, and most importantly, making judgments on whether you want to invest capital into a company or not. Understanding the upside, the downside with companies. Is that company worth our investments, or shall we keep our hands away? So how you can access 1000xstocks.com is you can go to the description area of this video, or you can go to 1000xstocks.com, apply for access to the service.
For being here, your own set with us. How has your view changed at all with what we've seen the past 6 months? We all talk about what happened a month ago. The whole soft landing narrative was a little bit less certain, I think, but now we're back fine, and the Fed gets an A for how it's handled this?
Hasn't changed much. I don't think we're getting a recession over the next 12 months. I think for Jackson Hole, Powell's going to want to be boring. He does not want to rock the boat here. The markets are on a knife's edge with every data point. And you saw what happened with the Bank of Japan, like a mini earthquake. So that's what Powell wants to avoid. One thing he said at the last press conference caught my attention, and it speaks to how the market is behaving right now. He went out of his way to say, we're data dependent, but we're not data point dependent. And so I think as investors, we have to move away from just being on this knife's edge where every single data point moves markets. It's not really healthy, especially with valuations that high.
So at one point, the market thought we'd get, almost 200 basis points probably. Then we got down to maybe 50, 75. Where are we right now, and what's the right level?
Yeah, so we're down to 3 cuts before the end of the year, 75 basis points. That's roughly what's priced in.
And will that continue next year? How many next year?
It probably continues. This is important. It's a potential regime shift for investors. We're getting into a Fed cutting cycle. What does it mean historically for markets? I just ran a study of 12 cutting cycles spanning 70 years. Now, I have to say, this environment is a little bit different because usually the Fed cuts when things get bad and worse than they are right now. The Fed wants to cut right now just because real rates, the rate after the inflation is getting high. But again, we don't see a recession. All that being said, 12 Fed cutting cycles, bonds outperform cash 12 out of 12 by an average of 8%. So with this regime shift, I think one of the things we're looking at as investors is, all this cash on the sidelines, is it time to start moving some of it into at least a diversified bond portfolio?
Really? And what would that look like in terms of duration? What would be the best place to be, do you think?
I mean, unemployment back in that 2007 time around where they cut was insanely low. It was around 4.5-ish, 4.7-ish percent. It was insanely low when they started cutting rates, right? And then we still had a complete disaster. So, you just can't bank on essentially the Fed starting to lower. It means great things like, unemployment's low right now, so that means it's going to stay low. Like, no, it's not really how it works.
Everywhere.
Right now we're actually short duration, but I think a diversified bond portfolio, we're looking at to reduce that underweight duration. So I'll tell you how we're positioned right now and what we're looking at. We're positioned with a cash buffer and some credit because we don't expect a recession. Where we're potentially moving, especially if rates come back up, maybe a last hurrah for the 10-year in the 4.5-5% range, that would be a good point, a good entry point if you want to be tactical, to diversify the portfolio, extend the duration, go closer to a broadly diversified, say, Barclays aggregate index duration. I think that's an opportunity because, rates are higher. And here's another thing, Joe. Bonds, as you've seen over the last few weeks, have started to diversify stocks again. And I've done a lot of work on the stock-bond correlation. It's a bit of a wonky thing, right? But as markets start to worry less about inflation and more about growth scares and the risk of a recession, whatever the probability is, maybe 20, 25%, as markets start to focus on growth risk, bonds can diversify stocks again.
You said that in previous cycles that we've seen, bonds outperform cash by 8%.
By a lot, yeah.
Okay. How much do stocks outperform cash or bonds?
Yeah, so that's a great question. The Fed usually starts cutting when things are pretty bad for the economy. So the equity risk premium, the amount.
It's just not true. I just ran you through the great financial crisis example, right? Unemployment was in the mid-4s. That's not bad. That's great. Like, unemployment in the mid-4s is great historically. And yet they started cutting, right? So look at the other example, the more recent one, when the Fed started cutting at the end of, 2018 going into 2019, right? Was the economy in a bad spot at the end of 2018 going into 2019? No, absolutely not. Economy was very strong. Overall, very strong, just to be quite frank. Very low unemployment. Real wages were in a decent spot. A lot of people had gotten some tax breaks. Obviously, the corporate tax rates had all gone through by that time. Like, I wouldn't say that was a bad time. And yet, the Fed started cutting. So this notion of the Fed only cuts when things are bad, that's not true remotely. Look at the last several cutting cycles.
Which stocks beat bonds is quite compressed. It's down to 2.2% historically across these 12 cutting cycles. But I would differentiate this upcoming cutting cycle in that this is not really a growth scare. I mean, we're on a knife's edge and things could change. But this is not as bad a situation, and I don't expect a recession. So ultimately, this is a bit boring, but we're at neutral, fully invested between your stocks and your bonds. Stay close to your long-term risk tolerance. That's how I think you play this market. We are long the broadening, though, Joe. I think this level of concentration, if I look out 12 months, it's bound to broaden. Value stocks have quietly outperformed growth stocks by 8% since July 10th.
Well, it doesn't sound like you'd be an 80-20. It sounds like you would favor bonds equal to stocks. Oh, just no, you don't like cash, but so
how I would position going into 2025 is be heavy your top 10, 15, 20 favorite stocks, right? Keep good amount of cash around. If you want to go heavy, 30% cash. If you want to go light, 10% cash into 2025. And then if you got big money, hedge in the fourth quarter of this year in case it happens, right? You never know. What if we're going to go into a Fed cut cycle where next thing you know, the economy completely falls off the rails? Next thing you know, unemployment's 5%, 6%, 7%. It can happen quick. You never know. And so just go in hedged. Who knows what happens, right? Hedge up maybe October, November. If market goes super risk on the next month, maybe even hedge up toward the end of September. And set yourself up. Whatever happens in 2025, let it be, right? That's fine. If the market goes nice risk on, your 10, 15, 20 stocks you own that you love are going to likely perform tremendous, right? If the market crashes, okay, those hedges should print money. Your cash is going to be looking really good because then you're going to be able to buy the dip heavily, right? That 10 to 30% you have in cash. And then let's say the market doesn't do a whole lot of anything. It doesn't really go up in any substantial way in 25, doesn't really go down in any substantial way. Well, if you've got really good companies, those companies should likely still perform very well, right? And then your cash should hold in there pretty decent because you should still be able to get in 2025 on cash in a high yield savings account or in treasuries. You still should be able to get 3 to 4%, which should outstrip inflation. So you're still looking good as far as that goes. The only risk is you might lose on your hedge if that didn't quite work out, right? But that's why when you hedge, small amount of money. It's kind of no different than when you invest in a spec stock. You put a small amount of money in. Very similar in regards to hedging. Hey, I want to thank you so much for watching that clip here today. I hope you really enjoyed that one. What you're looking at right now is 1000xstocks.com. 1000x does not just show you a billion different metrics that are completely irrelevant. It's curated, mandatory metrics, advanced metrics, curated for long-term investors, not for traders, so you can understand a company on the highest level possible, how it operates, and most importantly, making judgments on whether you want to invest capital into a company or not. Understanding the upside, the downside with companies. Is that company worth our investments, or shall we keep our hands away? So how you can access 1000xstocks.com is you can go to the description area of this video, or you can go to 1000xstocks.com, apply for access to the service. Next one up here. I think this one matters for SoFi and other stocks. Overweight financials?
Berger Berman, Senior Portfolio Manager Sandy Pomeroy, and Wolf Research Chief.
By the way, if you're looking for access to 1000xstocks.com, I'll put that as pinned comment down there today. You can apply to join us in 1000x, as well as get access to my private stock group, my private wealth group, teaching everything I got up here, take you up to a much higher level, become a great investor overall, and know what you're doing with confidence out there in the market. Plus, get access to our Discord chat with our 1,000+ member community.
Strategist Chris Senyak, a very good morning to you both. Sandy, I'll start with you in terms of what you're expecting in terms of rate cuts, not so much the next meeting, but by year end, because the market has raced once again to pricing in 100 basis points by year end. Is there room for the market to be disappointed with that?
So I would say that this is not my area of expertise, and I don't really have a strong view on it.
Do you not mind how many rate cuts there are for your equity positioning?
For equity positioning, I would just say that cutting rates is a little bit better for growth in the economy. So I would say in general, that's good for equities. I know that Chris has done a lot of work, though, in looking at the Fed futures, and we were talking about it earlier. You might have a better opinion on it.
Chris, what's your take?
I think that it's a signaling effect, and I think gives businesses sort of the confidence that they can start investing. They know the cost of capital is going to be falling over the coming months, however much it is. And frankly, I don't think it matters whether they cut 2 times or 3 or 4 times. It's a matter that they're cutting and rates are trending down from here. Whether we get to the 3% or 4% at sometime next year, I don't think is as important as the fact that they're cutting rates.
What does it do to the longer end of the yield curve? I mean, clearly we know what it does to the short end. And how important is it in terms of your then sector selection from there?
Yeah, in terms of the long end of the yield curve, I see some upward pressure to the long end because I think growth expectations are going to improve as we get through the end of the year into next year. Probably get some inflation coming back into the system, and that benefits financials. And that's why we're telling investors here that you want to be overweight financials. Financials now are slightly outperforming the S&P 500. They've had this sort of like stealth bull market underneath the surface. And some of the stocks like Goldman Sachs is up more than half of the Mag 7 stocks. So we'd be buying financials right here and right now into that steeper yield curve.
JPM hitting another all-time high this
Yeah,
morning.
it is. Sandy, you equity income, so that obviously means dividends to a certain extent.
Yep.
I don't know. Do they start to look more attractive as rates come down?
Oh, definitely. I mean, one of the competitions for dividend yielding stocks so far has been the fact that the short-term rate was about 5%. And so people are thinking, oh, if I just want income, why not think about putting it right in short-term bonds or T-bills? Now you're, going to have more competition in a good way. And I think the key thing is that dividend stocks grow their dividends over time. Bonds don't. And so if we get any kind of resumption of inflation with a little bit more growth, that is definitely going to favor dividend paying equities. So you get the income and you get the growth and you get the dividend increases. So all good stories for dividend paying stocks.
I mean, stock picking still has to matter here too. I noticed Merck up there. I mean, after the last quarter, that stock declined double digits. That, great, your yield goes up, but meanwhile, your total return is not.
Yeah, so we look at all our pharmaceutical companies in the exact same way. And what we do is we do DCFs of every individual drug in the whole portfolio that has been approved. Then we kind of look and see whether we're overpaying for the pipeline. And when we bought Merck originally...
They do a discounted cash flow of every single product they got? What?
It literally was
That's
trading
wild.
at the discounted cash flow value of every single drug they had that had been approved. At this stage, they've got some great drugs, they've got good pipeline drugs, and we think that there's still a lot of potential here. We think it's undervalued, and this is a buying opportunity for Merck from our perspective.
Okay, that was interesting. Already